Hey everyone, and welcome back to the channel. Today we're diving deep into some fascinating and honestly quite subtle developments happening in the silver market. Over the past few days, something significant has been brewing, but it's not the kind of thing that makes flashy headlines. Instead, it's showing up in the nuts and bolts of how the market operates, through signals that usually only appear when the system is under some real pressure. Now, normally markets are pretty good at handling ups and downs. Volatility is part of the game. But what we're seeing now is different. The adjustments are happening right out in the open, through public notices and routine operational updates that are giving us a rare peek behind the curtain. One of the most telling signs was when a major government-linked player temporarily suspended sales of some of its retail silver products. Their official reason? They needed to recalibrate their pricing systems because of how fast the market was moving. On the surface, this sounds like a standard procedural move, and it is. Companies that make or sell physical goods often hit the pause button when their costs are rising faster than they can update their prices. A single pause like this isn't a big deal on its own. We've seen it before, but context is everything. What makes this particular pause so interesting is what was happening in the broader market at the time. Silver prices were experiencing incredibly sharp, rapid movements over very short periods. Think about it from the perspective of a manufacturer or a distributor. They need time to hedge their exposure and manage their risk. When prices are zipping up and down that quickly, it compresses that time, making it incredibly difficult to operate. For any business that works on fixed margins for creating products and has a public price list, this kind of environment is a huge operational headache. To sell a physical product, like a silver coin or bar, you need to be confident that you can buy more silver to replace your inventory at a predictable cost. When the price is changing faster than you can manage your supply chain, friction starts to appear, and that's exactly what we saw. It's really important to understand what this kind of suspension means and what it doesn't. This isn't necessarily about a physical shortage of silver. A pause doesn't mean there's no metal left to buy. What it often signals is a high degree of uncertainty. Uncertainty about what it will cost to replace the silver they just sold, uncertainty about logistics and delivery times, and uncertainty about their own internal risk controls. They're essentially saying, hold on, things are moving too fast. We need a moment to catch our breath and figure out the right price. If we look back through history, we can find similar situations across all kinds of markets, from other metals to energy and even agricultural commodities. Whenever there's a period of rapid price movement, these operational pauses tend to happen. And typically once the volatility dies down and the market finds a new level, things go back to normal. But here's where it gets more complex. This isn't just about one company pausing sales. We're seeing a pattern of stress signals across the board. For example, some exchanges have had to adjust their margin requirements. Margins are like a security deposit that traders have to put up to cover potential losses. When an exchange raises margin requirements, they were essentially telling traders that the market has become riskier and they need more collateral to participate. This acts as a brake on speculation and can help cool down a volatile market. We're also hearing reports from dealers and mints about widening bid-ask spreads. The bid price is what a dealer will pay you for your silver, and the ask price is what they'll sell it to you for. The difference between them is the spread. When that spread gets wider, it's another sign of uncertainty. Dealers are protecting themselves from the risk of the price moving against them and the time it takes to complete a transaction. Think of it like this. The entire silver ecosystem, from the large exchanges down to the local coin shop, is interconnected. When one part of that system shows signs of strain, it can ripple through the rest. The suspension of sales, the increased margin requirements, and the wider spreads are all different symptoms of the same underlying condition: intense price volatility and uncertainty. So what's driving this volatility? It's a combination of factors. We have macroeconomic data coming in that's shifting expectations about inflation and interest rates. Geopolitical events are adding another layer of uncertainty. And on top of all that, we have strong speculative interest from traders who are trying to capitalize on these price swings. All these forces are converging on the silver market at the same time, creating a perfect storm for price discovery. The market is essentially trying to find a new equilibrium price for silver, and it's doing it in a very turbulent environment. This process is never smooth, it's messy, and it creates these operational frictions that we're now able to see so clearly. Now, what does this mean for the average person interested in silver? First, it's a reminder that physical ownership is different from just owning a paper contract. When you hold physical silver, you are insulated from some of these operational risks at the exchange level. But you are exposed to others, like wider premiums, and potential temporary difficulties in buying or selling from dealers. The premium is the amount you pay over the spot price of silver. During times of high demand and volatility, these premiums can increase significantly. This is the market ordinaire way of balancing physical supply and demand when the paper price is moving all over the place. The events we're seeing are a real-world lesson in how the spot price you see on your screen and the actual price you pay for a physical product can diverge. Looking ahead, we need to keep a close eye on these operational signals. Will the sales suspensions be lifted quickly? Will the bid-ask spreads start to narrow? Will margin requirements come back down? The answers to these questions will tell us a lot about whether the market is stabilizing or if we are in for a longer period of turbulence. This is a dynamic situation, and it's a fascinating case study in market mechanics. It's not just about the price going up or down. It's about how the entire infrastructure that supports that price responds under pressure. These aren't just abstract concepts. They have real-world implications for anyone involved in the silver market, from the largest institutions to individual collectors. It highlights the fundamental tension that can sometimes exist between the fast-moving world of financial markets and the slower, more tangible world of physical commodities. When those two worlds get out of sync, you see exactly the kind of friction we've been talking about. So, for now, the key takeaway is to watch the mechanics, not just the price. These subtle signals from behind the scenes are often more telling than the headline numbers. They give us a much deeper understanding of the health and stability of the market. We'll continue to monitor this situation and bring you updates as it unfolds. This is a story that is far from over. Thanks so much for watching today. I hope you found this breakdown helpful. If you did, please hit that like button and consider subscribing so you don't miss our future updates. And as always, I'd love to hear your thoughts in the comments below. What do you make of these developments in the silver market? Let's discuss it. Stay safe, stay informed, and I'll see you in the next video. Hey everyone, and welcome back to the channel. Today, we're diving deep into the silver market, but we're going to look beyond the usual headlines and retail stories. We're going to explore what's happening behind the scenes in the wholesale physical market, because that's where some of the most interesting developments are taking place. It's a story of volatility, risk, and some very noteworthy inventory movements that could signal a shift in how major players are thinking about silver right now. So, grab a coffee, settle in, let's unpack what's really going on with the physical metal. While many of us are focused on what is happening at the retail level, the prices we see online or at our local coin shop, the wholesale physical market has been experiencing its own drama. During the same period, we've seen retail adjustments. Wholesale silver prices have been hitting levels we haven't seen in decades. But it's not just the price level that's remarkable. It's the volatility. We're talking about daily percentage swings that are far beyond the historical norm. Now, you might think, so what? Prices go up, prices go down. But for the people who make up the physical supply chain, the manufacturers, the large dealers, the wholesalers, this kind of volatility is a major headache. Their business model isn't about betting on whether the price of silver will go up or down. Instead, they rely on stable spreads. A spread is simply the difference between the price they buy at and the price they sell at. When prices are swinging wildly, that stable spread becomes incredibly difficult to maintain. Imagine you're a wholesaler. You buy a large quantity of silver, expecting to sell it for a small, predictable profit. But if the price drops dramatically overnight, you could be facing a significant loss before you even have a chance to sell your inventory. On the other hand, if the price skyrockets, the cost to replace the inventory you just sold becomes much higher, eating into your profits and introducing a new kind of risk. This is the core problem that extreme volatility creates. It forces everyone in the supply chain to constantly reassess their risk. So, what happens when this risk level gets dialed up to 11? Well, a few things. First, you'll see premiums widen. The premium is the amount you pay over the spot price of the metal. For a dealer, a wider premium is like an insurance policy against that volatility. It gives them a bigger buffer to protect their business from those unpredictable price swings. Second, delivery timelines might get longer. With so much uncertainty, logistics get complicated. Companies might become more cautious about committing to rapid delivery schedules. And third, some participants might just decide to sit on the sidelines. They might reduce their trading activity, waiting for the market to calm down and for some clarity to return to pricing. It's important to understand that none of this means the system is failing or that there's a massive conspiracy afoot. It's a natural, rational response to heightened uncertainty. It is the market's way of pumping the brakes when things get a little too wild. This leads to a fascinating feedback loop between perception and reality. Let's go back to those premiums. A dealer might raise their premiums, not because they can't get silver, but because the risk of replacing the silver they sell has gone up. However, a buyer who sees that higher premium might immediately think, oh no, there must be a shortage, the metal is running out. This perception can then drive more urgent buying, which puts further pressure on the available supply and can even push premiums higher. It becomes a self-reinforcing cycle where the fear of a shortage can create the very market conditions that look like a shortage. even when plenty of metal exists, just at a higher price. This is a critical distinction to make. Higher premiums don't always equal a physical scarcity. Often they are a direct reflection of increased risk and volatility in the wholesale market. The metal is there, but the price to acquire it and move it through the supply chain has gone up because the risk of doing business has gone up. Understanding this helps us interpret the market signals more accurately instead of jumping to conclusions. Now, let's add another layer to this story, and this is where it gets really interesting. During the same period of high volatility, we've seen some very unusual movements in the exchange-reported warehouses. These are the large depositories, like those managed by COMEX, where massive amounts of physical silver are stored. The data shows notable net withdrawals of physical silver across several of these major vaults. In other words, more silver was being taken out than was being put in. But the devil is in the details. We need to look at which silver was being moved. A significant portion of these withdrawals appeared to come from privately held inventory. This isn't metal that's earmarked for settling futures contracts or for immediate delivery obligations. This is metal that's typically associated with long-term storage. Think of it as the deep savings account of the silver market, not the daily checking account used for trading. Why does this distinction matter so much? Because movements in this privately held category are not routine. They suggest a more fundamental shift in thinking among the owners of that metal. It's not just about daily clearing activity or settling a contract. When long-term holdings start moving, it signals that the owners are making strategic decisions about their assets. It points to a change in preference rather than just business as usual. So, what are the possible explanations for these large private withdrawals? There are several plausible theories, and it's likely a combination of factors. One explanation is simple logistics. It could be a reallocation of assets, moving silver from one vault to another for reasons of cost, security, or convenience. Nothing more, nothing less. Another possibility is arbitrage. If the price of silver in one market, say London, is significantly higher than in another market, like New York, it makes financial sense to withdraw the metal from the cheaper location and ship it to the more expensive one to sell for a profit. With global markets and instant information, arbitrage opportunities are a constant feature of commodity trading, and large players are always looking to capitalize on them. A third, and perhaps more compelling explanation, is risk management. During periods of high volatility and market uncertainty, some investors and institutions might simply prefer to have direct physical control over their assets. Moving metal out of a shared depository and into a private vault gives them ultimate control. It's a move that prioritizes security and possession over the convenience of exchange storage. This doesn't necessarily imply they think the exchange is going to fail, but it does reflect a desire to reduce counterparty risk to zero during a turbulent time. It's crucial to note that none of these explanations, logistics, arbitrage, or risk management, implies distress in the market or some kind of coordinated action. They are all consistent with large players acting rationally in their own self-interest under conditions of uncertainty. But the timing of these withdrawals is what makes them so noteworthy. It adds a fascinating dimension to the price action we're seeing. Let's think about historical patterns for a moment. Typically, when the price of a commodity like silver rises significantly, and holders believe that price is getting a bit stretched or overvalued, what do? They sell. They offer their metal into that strength to lock in profits. This means you would normally expect to see inventories in the warehouses rise during a strong price rally as more metal comes onto the market. However, what we've been observing is the opposite. We've seen inventories decline during a period of rising prices. When you see owners pulling metal out of warehouses while prices are going up, it can suggest something very powerful. It can suggest that these owners value the possession of the physical metal more highly than the immediate liquidity they could get by selling it at those high prices. Think about that for a second. The price is attractive, offering a great opportunity to sell for a profit. Yet these large holders are choosing to take delivery and hold on to the physical asset instead. This behavior hints that they may believe the current prices are not the peak, or that the long-term value of holding the physical metal outweighs the short-term benefit of cashing out. It's a vote of confidence in the future of the asset itself, and it's a signal that we should all be paying close attention to. So, to wrap it all up, we have a wholesale market dealing with extreme volatility, which is causing premiums to widen and creating a feedback loop of shortage perception. At the same time, we have significant withdrawals of long-term silver holdings from major depositories during a period of rising prices. This is the opposite of what we'd normally expect and suggests that major players are prioritizing physical possession over cashing in at current levels. This doesn't tell us where the price is going tomorrow or next week, but it does provide a much richer, more nuanced picture of the physical silver market right now. It shows a market grappling with risk, but also one where deep-pocketed players are making strategic moves that signal a strong conviction in the value of holding the physical metal. It's a complex and fascinating puzzle, and these behind-the-scenes movements are critical pieces. Thanks for watching, everyone. I hope this gave you a new perspective on the silver market. If you found this analysis helpful, please hit that like button and be sure to subscribe for more deep dives into the markets. Let me know your thoughts in the comments below. See you in the next video. Now, this isn't necessarily a sign of a crisis. Local demand, currency fluctuations, or even specific regulations can cause these price differences. But when they stick around, it creates a powerful incentive. It's simple economics. Silver starts to move from lower-priced regions to higher-priced ones. In normal times, this flow is smooth, a process called arbitrage that helps balance the market. But right now, things are volatile. Instead of a steady stream, we're seeing big, concentrated bursts of silver moving across the globe. This leads to something many of you have probably noticed: visible inventory drawdowns. You look at the official numbers from exchanges like the COMEX or the LBMA, and you see the stockpiles shrinking. This can cause temporary tightness in the retail market, making it harder or more expensive for everyday buyers to get their hands on coins and bars. But it's crucial to understand this isn't necessarily a system failure. It's the global market working as intended, just under a lot of stress. It's reallocating supply to where it's most in demand, but it's happening in a very choppy and abrupt way. Now, it's important to consider the counter-argument, and it's a strong one. The silver inventories that we see on exchanges are just the tip of the iceberg. They represent only a small fraction of the world's total silver supply. Huge amounts are held in private vaults, stored in industrial warehouses as part of manufacturing supply chains, and even sitting in our homes in the form of jewelry and silverware. From this perspective, a drop in exchange inventories isn't a sign of a worldwide shortage. It's more like money moving from one bank account to another. The total amount of silver isn't necessarily changing, just its location and how it's being counted. Long-term data really supports this view. If you look at historical trends, you'll see that exchange inventories have always fluctuated, sometimes dramatically. It cautions us against drawing a straight line from falling visible stockpiles to an impending global shortage. The world is not running out of silver. However, markets don't always react to the full, invisible picture. They react to what they can see. And when traders, investors, and the media see reported inventories falling day after day, it has a powerful psychological effect. This brings us to market sentiment. When you combine falling visible inventories with those high physical premiums we talked about and add in some friction in the retail supply chain, like delivery delays or higher costs, it creates a narrative. The feeling in the market begins to shift, regardless of the vast, unseen stockpiles. People start to believe that silver is becoming scarce, and that belief can become a self-fulfilling prophecy, at least in the short term. Right now, we have a perfect storm of indicators all pointing in a similar direction. We have elevated volatility, which makes everyone a bit nervous. We have significant changes in the physical market, with premiums staying high. We have inventory movements that suggest a strong preference for holding physical metal rather than a paper contract. And we have reports of bottlenecks in the retail distribution channels. Individually, any one of these things could be dismissed as a temporary blip. A volatile week? It happens. High premiums? They come and go. A dip in inventories? We've seen it before. But when you see all of them happening at the same time, it suggests something more significant is underway. It points to a market that is in a state of transition. It's not necessarily breaking, but it is definitely changing. The old patterns of behavior are being tested. So where do we go from here? The focus really needs to shift from trying to predict the future to carefully observing the present. Instead of asking, will the price hit this target? We should be asking, what are the key indicators telling us right now? First, we need to watch those inventories. Do they continue to decline, stabilize, or start to rebuild? This will be a critical sign of supply and demand pressures. Second, what happens to the premiums? Do they stay elevated, suggesting that the demand for physical metal remains intense, or do they start to come back down to more normal levels? Another key thing to watch is the operational side. We've seen some logistical hurdles and even temporary pauses in operations at mints and refineries. Will these businesses be able to resume their normal activities smoothly? Their ability to ramp up production and clear backlogs will be a major factor in easing the tightness in the retail market. And finally, we need to monitor those regional price gaps. Will the price differences between, say, London and Shanghai narrow as arbitrage does its work, or will they persist, indicating ongoing structural stress in the global supply chain? It's very rare for a market to go from a state of surplus directly to a state of shortage overnight. That's not how complex global systems work. Instead, they oscillate. The market pushes and pulls, testing price levels to see how buyers and sellers react. It tests the limits of logistics, seeing how quickly metal can be moved from point A to point B. This period of testing is exactly what we're in right now. Based on all the evidence we have, the situation points more toward a major market adjustment rather than a complete breakdown. Physical silver isn't vanishing into thin air. It's being reallocated. It's moving to new owners, to new locations, all in response to powerful price signals and changing incentives. The big question is how this adjustment resolves. How quickly will the current volatility die down? And how effectively will the supply side, the miners, refiners, and mints, respond to the high demand? The answers to these questions will determine whether the current friction smooths out into a new, stable equilibrium, or if the market simply snaps back to how it was before. Therefore, the most sensible approach for anyone interested in silver right now is to be an active observer. It's about monitoring these key data points, prices, premiums, and inventories over time. It's about understanding the flows and the frictions. We need to avoid jumping to premature conclusions based on one or two exciting but isolated data points. The story of the silver market is still being written, and the next few chapters will be determined by the collective actions of millions of participants around the world. Thank you so much for watching this detailed analysis. I hope it provided some clarity on what's happening in the silver market. It's a complex topic, but by looking at all the moving parts, we can get a much better picture. If you found this video helpful, please hit that like button and consider subscribing for more deep dives into the financial markets. Let me know your thoughts in the comments below. See you in the next video.